Ladies and gentlemen, good day and welcome to the Q4 and FY23 earnings conference call of Ramkrishna Forgings, hosted by Emkay Global Financial Services. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Chirag Jain from Emkay Global Financial Services. Thank you, and over to you, sir.
Thank you, Darwin. Good evening, everyone. On behalf of Emkay Global, would like to welcome you all to this earnings call of Ramkrishna Forgings Limited. Today we have with us
Mr. Jain. Ladies and gentlemen, the line for the management and Mr. Chirag Jain seems to have disconnected. Please stay with us while we reconnect with them. Thank you for your patience, ladies and gentlemen. We have reconnected with the management. Over to you, Mr. Jain.
Thank you, Darwin. Apologies for this inconvenience. The line got disconnected. Good evening, everyone. On behalf of Emkay Global, would like to welcome you all to this earnings call of Ramkrishna Forgings Limited. Today we have with us from the management team, Mr. Naresh Chalan, Managing Director, Mr. Lalit Khetan, Whole-Time Director and Chief Financial Officer, and Mr. Rajesh Mundra, Company Secretary and Vice President Finance. I shall now hand over the call to Mr. Lalit Khetan for his opening remarks, post which we will open the floor for Q&A session. Over to you, sir.
Thank you, Chirag. Good evening, ladies and gentlemen. On behalf of Ramkrishna Forgings, I would like to extend a warm welcome to everyone. We are pleased to report that despite the ongoing challenges in the global economy, we have delivered strong results in Q4 FY23, creating sustainable value for all our stakeholders. India's commercial vehicle segment has witnessed a remarkable growth in recent times. With the increase in economic activity and infrastructure development, the demand has surged. In addition, the government's focus on boosting the manufacturing sector and implementing various initiatives such as Make in India and Atmanirbhar Bharat has also given a significant impetus to the sector. The commercial vehicle segment in India is poised for further growth in the coming years, driven by economic expansion, infrastructure development, and adoption of cleaner technologies. We are excited to share that Ramkrishna Forgings and Titagarh Wagon Consortium has received LOA for manufacturing and supply of forged wheels for Indian Railway, which is a significant milestone for our company. The order size is 12,226 crores, and it is a long-term contract of 20 years, which adds to our strong revenue visibility for the coming years. Additionally, we have renewed a long-term contract with an overseas Tier 1 customer based in North America, which included an additional new product range. This contract renewal and additions bring the total number of contracts to 8 during the year, totaling rupees 774.70 crores from various geographies and business verticals, excluding the long-term order from the Indian Railways. Ramkrishna Forging has also taken a step forward towards sustainability by planning to set up a 7.82 megawatt rooftop solar power plant
which will help reduce our carbon footprint and contribute to greener future. The total cost of project is estimated to be around rupees 35 crore. This investment reflects our commitment to responsible business practices and our dedication to reducing our carbon footprint. We are pleased to see an increase in demand for our products, which has led to significant revenue and profit growth. In Q4 FY23, we have recorded a revenue of rupees 835 crore, representing an year-on-year growth of 22%. And for the full year FY23, we recorded a revenue of rupees 3,001 crore, representing a year-on-year growth of 31%. EBITDA margin for Q4 FY23 is 22.52%, expanded by 42 basis points sequentially, and we are confident of sustaining the margins, and endeavor is to improve upon the same. Our net profit after tax was INR 67 crore versus 86 crore for the previous quarter, year-on-year. But however, that was due to the deferred tax reversal in the previous year. If we correct the tax impact, the profit after tax is increased by 25% from the previous year in the Q4. We are also pleased to announce that our long-term rating has been upgraded by ICRA and India Ratings to A+ with outlook, stable outlook. This reflects the confidence of rating agency in our company's financial state and growth prospect. Thank you all for your continued support. That's all from my side.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may please press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Mumuksh Mandlesha from Anand Rathi. Please go ahead.
Thank you so much, sir, for the opportunity, sir. So can you share some light on the railway wheel project? What kind of capex plan and how do you see the revenue flow from FY26? And some light on the profitability side, sir. Hello. Hello.
Total project outlay on this cost on this project will be close to 1,200 plus crores, and the LOA which we have received from railways is close to around 12,500 crores for 20 years, starting FY27 onwards. That's the reason we have mentioned also in our presentation that we expect to start production from last quarter of FY26. And we are setting up, while railway requirement and confirmed guarantee is for 80,000 wheels per year, we are setting up this capacity for 2 lakh plus wheels. And we expect to do a business of close to around 28,000 crores over next 20 years from this project. And profitability, right now it's being worked out. I think we can safely say that the current margins which we are doing in standalone basis in RKFL, we are aiming for similar margins in the joint venture.
So the additional capacity which you are planning for the field, is it will be for export market or what kind of opportunity you are seeing, sir?
I think the 80,000 is for railways self-consumption for OE application. And plus, I think there is a huge market within India for wear and tear, as well as the wagon builders and as well as the privatization of railways which are happening in Vande Bharat. Right now they are importing wheels, so those also will be required. And as well as export market is huge. And there is right now very limited capacity globally post the Ukraine war. So we are already in touch with a lot of OEMs globally who buy wheels. And I think before the plant commences production, we will have a long-term contract with these OEMs also.
Right, sir. Sir, can you share an outlook for the overseas CV market for next 1 year, sir?
I think the overall global market right now in export is strong, and we expect it to remain strong over the year.
Right, sir. Sir, can you provide timeline for the completion of the GMT Auto and ACL acquisition, sir? And the post-acquisition, what would be the CapEx plan for both the companies, sir?
I think GMT Auto and ACL both are from our side. Whatever we could have done, we have done. It is right now at Indian legal system. So we are hopeful of having this as fast as possible, but I think legal process takes its own time. So we would not like to comment on exactly the timelines of it. In terms of capex, I think both taken together to modernize the plant and bring it up to the shape, we expect close to, including both, to close to around 200 crores of capex will be required to get 100% result from both the plants.
Thank you so much, sir, for the opportunity, sir.
Thank you. The next question is from the line of Abhishek from Dolat Capital. Please go ahead.
Thanks for the opportunity and congrats for a great set of numbers, sir. Sir, you have won the new orders from the railway for supplying 2 lakhs for supplying a huge wheels, and the total wheels production would be around 2 lakhs per annum. So, what would be the total project cost, and what would be your sharing for that?
I think this JV is at a 51-49% model, and the similar we will share the share of finances also will be similar, and we expect a capex of close to around approximately 1,200 crores plus minus 5% at the current levels of market.
And so the revenue won't be added in your top line. It will come into your bottom line.
No, revenue will be added in my console, as well as the profitability will be also added in my console.
Okay. So it won't be shown as a JV profit.
But I think we at a 51%, 14%, we will need to have a consolidated balance. We will need to bring that 51% of the revenue into my console.
Okay. And sir, in domestic market, basically the BS6 number was because of BS6 phase 2 numbers was quite strong in 4Q, but there's an expectation that FY24 number would be muted. So can you give some color on how the outlook would be for the domestic market in MSCB segment?
I cannot comment on the exact market shape. I can only comment on what RKFL is, and we are extremely confident of a strong performance in FY24. And given the global scenario, given the domestic market, and given the order book we right now have and the visibility we have from all our customers, we expect to continue our growth trajectory, and we produce strong results.
So in earlier quarters, in quarter third, you had mentioned that you are looking for the 15 to 20% kind of the growth in the top line in tonnage segment. So your guidance is intact despite this strong base in the quarter 4 number?
I think my quarter 4 numbers already are visible in terms of tonnage growth, and I think we will continue to have similar growth, or as I say that we expect to have a very strong year FY24.
Okay, sir. So in last 2 years, sir, capex was very strong, and you have done a great numbers in your top line as well. Going ahead, you are coming with the 2-3 acquisitions, and plus that you are going to set up a plan for the this forge wheel side. So what would be your next 2 years capex target, FY24 and 25?
Standalone basis, RKFL will continue to grow and continue to deploy cash. In terms of whatever we earn, we have already defined our capital allocation policy. We will be strictly following those capital allocation policy in terms of our debt reduction, as well as allocating capital for the growth of RKFL on standalone basis. Acquisition, we will see as and when it comes. I think right now, till we complete the legal process, I would not like to comment on those, but in standalone basis, RKFL, we can very clearly say that we have a defined capital allocation policy, and we will follow the policy strictly in terms of debt reduction, dividend, and whatever is leftover cash, will deploy it back into the growth of the capacities within RKFL.
But you're most of the acquisition on the consolidated basis. So if you can throw some more light on that, how much capex you are looking in the ACL, JMT, as well as your other plants like force plant, and what is your debt repayment plan?
JMT, ACL, already my acquisition cost has already been in the market domain. So unless it comes right now, I will not be able to say anything when and how it will happen. So we will wait till the court order comes through, and then only we will be able to comment on that, and we will surely keep investors updated as and when the acquisition gets cleared through the legal process. And in terms of the wheel project, my responsibility is for 51% of the capex spend, and part will be funded through debt and equity. So equity is the portion which RKFL will bring into that SPV. So we are working out. I think we are not yet freezed on the numbers, and I think it will be by first quarter we will give you the numbers what RKFL intends to get in equity in that company and what is the debt going to be that in the company. But that is over next 3 years, which is going to happen.
And what is the ROC of this business, force wheel business, sir?
I think right now we will need to wait, because I think we are still at a 40% capacity, or not even 40% capacity has been sold. So we will need to wait for the rest of the contracts and other things to get closer. And closer to, I think FY23 we should be speaking on what is going to be the ROCE. Right now, when we have quoted for the project, we have quoted on an ROCE of close to around 5.5 years.
Okay, sir. Thank you, sir. That's all from my side.
Thank you. The next question is from the line of Bala Subramanian from Arihant Capital. Please go ahead.
Thank you so much for the opportunity, sir. Sir, my first question on the wheel set side, we are going to sell FY26 kWs. Sir, what would be the average realizations for these wheels? And because we are going to supply for next 20 years, what kind of price escalation clause we have with Indian Railways? These are my first question.
I think the price realization right now shared it in the market is 90 rupees.
So could you please repeat? I'm not getting it.
190 rupees per kg, close to 190 rupees per kg realization right now. And the escalation clause is very clear that it is as determined by every quarterly in the RBI index of steel and inflation.
Okay, got it, sir. So my second question on the wheel set side, how many wheels we have to sell for break even in that project?
It will break even at 40,000 wheels per annum.
40,000 wheels. Okay, sir. So I just want to understand about the wheel sets market in overall in global, like in that wheel sets cost, it can any be forged wheel sets. It comes anywhere between 2.5 to 2.8 lakhs. So could you please break down that what are the components are available?
I think it is not relevant question right now, and it is very difficult for us to answer right now. It's a just project which has been taken up, and we are working on it, and it is right now very preliminary to give all those information.
Okay, thank you, sir.
Thank you. Ladies and gentlemen, in order that the management is able to address questions from all participants, you are requested to limit your questions to 2 per participant. The next question is from the line of Pratik Banthia from Girik Capital. Please go ahead.
Yeah. Hi, Lalitji. Dhawan here. Sir, my question is related to the slide 20, where you are mentioning about warm forging capability. So, if you could, just tell us about this new capability which you are adding to our portfolio, And we mentioned under product families about differential gears and differential pinions. So, how many other players are there in India, in this, and which customer segment we would be targeting? Yeah, that's my first question.
In warm forging, we have already, since last quarters, we have already started supplies to domestic and overseas customers. And primarily right now we are catering to the commercial vehicle market, and with the new installation which is getting completed in next couple of months, we are going to target the light vehicle market also. And for which we have already got some contracts, and we are in process of getting some contracts globally and within India. To answer your second question, I think the biggest player within the Indian market in this segment is Sona Comstar, and I think we are just starting part of this, and we will gradually grow in this business, and I think we look to make significant progress over next 2 years, and this is the first step to make entire differential assembly as one of our product platforms.
Interesting. Sir, after with this product coming in, now our average EBITDA per ton, how will that move? Like for this under warm forging, what sort of profitability is there in the product?
I think right now in last 2 quarters we are not very significant player right now. So we will continue to work on margins in this, and with the installation of and modernization which is taking up right now, which is going to get completed, I think in next 6 months time, we are looking at least 100 to 150 basis more than what we are on an average doing in our traditional forging setup in warm forging.
Got it, sir. And sir, so now on the this question on the balance sheet and cash flow side, in the current setup and the current in our organic way which we are going by expansion, over next 2 years or by 3 years, we'll have a significant cash flow coming in. So how will our debt on books be? And we also have this JMT ACL where you'll be investing 200 crores and plus railway project also. So how will over next 3 years, how the cash flows will be used? Because you seem to be, fairly confident about the growth from the existing setup. So how will this cash flows be used?
See, our cash flow in the future, whatever we have the cash flow and we have the future growth plans, our future cash flow will be enough to take care of our and working capital requirement. So overall, we are not anticipating to increase on debt. Whether every year the debt will go down, at least, even if you look at the standalone basis, it will be at least 200 crore. We will go down, and on the console basis also, the overall debt will not increase.
Okay. So this 1200 crore debt which is there as on March 31st, 23. So over next 3-year period, this absolute number will keep coming down.
Yes, it will keep coming down with the growth also and acquisitions also. And on a standalone basis, it will continue to go down by at least 150 to 200 crore per annum.
No, and as well as also 1200 crores is the gross debt. At the net level, if you see minus the bill discounting, 1093 crores is only the net debt. And we expect the net debt to be on the downside going forward with the cash flow come out of the operations.
Correct. And how much will be our contribution towards this railway project?
That will be 180 crore of equity will go, and that will also go over a period of 3 years.
Over a 3 year, okay. So it won't be too stressful for us in terms of cash. Got it. And so we have just removed the 5,000 crore figure from the presentation. Any specific reason?
Basically, we do not want to put a number right now. We are looking at a extremely strong growth in next 2 years and 3 years with the kind of plans and the vision we have. So we did not want to put a number to it. Number may exceed expectations. So we don't want anybody to judge the company based on those numbers.
Correct. Got it, sir. Got it. Thank you very much and good luck. Thank you.
Thank you. The next question is from the line of Mitul Shah from Reliance Securities. Please go ahead.
Thank you for the opportunity. Sir, one clarification of previous question on debt. So we said that standalone debt will keep coming down and consolidated will not go up. So can we assume that consolidated for some time would remain at current level or it will also come down?
Mitul, it depends upon a lot of things when the acquisitions approval come and when we need to deploy the capex. So see, and the capex will be done also in a calibrated manner, and those companies will have their own earnings also with that capex. So everything will pan out in a span of time. But right now, that's very clear, and the vision of the company is very clear that on standalone debt we are going to reduce, and on consolidated also we are endeavor is to not increase the debt, rather reduce the debt. So that will continue, because whatever cash flow is available, we will try to grow from that only.
Okay. The second question on raw material side. In fourth quarter, RM by sales raw material as a percentage of sales has gone up by 200 basis YOY as well as QOQ. So now it is coming almost 8 quarter highest at 50.2%, whereas actual raw material price movement is very limited during the quarter. So any specific reason, any delay in compensation from the vendor, or what could be the reason behind this?
That's basically, that happens due to the product mix, because we sell the product of different categories, and that's why there is a function of sales realized versus raw material consumed. So that's why there is a 100-200 basis point plus minus quarter on quarter, and that has nothing to do with the right now price movement or any discount from the vendor.
Okay, so there is nothing related to delay or lag effect of passing cost escalation to vendor or anything like that.
Yeah.
And so at the same time, other expense also came down significantly Q on Q despite our revenues and volumes going up. So here any specific reason?
So other expense has gone down due to the reduction in freight, ocean freight basically, and shipping costs.
Okay, sir. And sir,
sir, sorry to interrupt. If you have any further questions, we request you to please rejoin the queue.
Yeah.
Thank you. Ladies and gentlemen, you are requested to please limit your questions to 2 per participant. The next question is from the line of Pritesh Chheda from Lucky Investment Managers. Please go ahead. Mr. Pritesh Chheda, the line for you is unmuted.
अरे कुरियर टू कुरियर हो, दीमक थोड़ी नहीं, मैं तेरे को कुरियर करूँ, तू सीधा कुरियर में डाल दे, तेरे ऑफिस पे आएगा, स्टैंप मार. हाँ.
Ladies and gentlemen, we will proceed with the next question from the line of Chirag Shah from White Pine Investment Management Private Limited. Please go ahead.
Hello.
Yes, sir, you're audible.
Thanks for the opportunity, sir. So congrats for good set of results. So first, before I ask my question, a clarification on this JV. So is this a completely ground up plant, or some part would be done by RK Forging in standalone, like a basic forging, and machining would be done at the JV level, or it is a completely ground up plant?
It is a completely greenfield project.
Okay. So everything would be done over there. Okay. So my question pertains to EU and US customer. So in the past, you have been indicating that you are in discussion with a few customers, and you are very hopeful of adding some of them. So any update if you can share on that, it would be helpful. Any new customers you may have added?
Lalit has already updated close to 700 plus crores of order wins in this year.
Mm-hmm.
Is basically on whatever we have been able to complete in terms of our customer acquisition is concerned. And in terms of revenue, if you see already Europe is growing. In absolute numbers, if you see, Europe is close to 15% now of our total revenue. Starting from a base of 0, and within 2 years we have reached a revenue of close to 15% from the Europe. So I think that substantiates our statement, what I have said, that we are working on customers and it takes time, but customers are getting converted as we move up.
Yeah, no, so I was more referring to number of customers. So because I understand, sir, customer breakthrough could happen immediately or could take number of years. It depends upon when and how they want to ramp it up. So is there any breakthrough being made that where a new customer has given some trial orders or we have got some approval?
Yes, that is the answer to it, that we have already converted a lot of customers wherein we were doing trials, and that is the reason this kind of revenue we were able to achieve in this set also. And with the strong growth, what we see is basically the marketing activity which we have done over the years, from where we are still having a visibility of a very strong year going forward.
And sir, this breakthrough is largely in US or it's more Europe driven?
It is globally.
Okay,
I cannot put a particular geography to it, but we are overall, in terms of overall performance, we expect strong growth and we are extremely happy with the customer response globally.
And sir, and last question on cold and warm forging. So it was supposed to start in Q1, right? Operationalization of that asset. That incremental.
I think last 2 quarters already we are started doing warm forging, and the latest new equipment which is entrant, we are in process of starting that equipment. I think from second quarter onwards, by that we have already very clearly mentioned all this capex of addition of 56,000 tons will get completed on or before September 23, and we have already given an entire roadmap by first quarter what is going to get completed, and by second quarter what is going to get completed.
Yeah, but my question was, how should we look at ramp up of this plant?
So this is basically a ramp up plan. Capex, if it is getting completed and commissioned and start up, so we have immediate order book to ramp it up. So we have given guidelines based on ramp up plan itself, that first quarter and we will be able to see the tonnage mentioned. The ramp up will happen from second quarter, and the second quarter, the part which is getting completed from third quarter, we'll see the ramp up on those.
So basically, once you start the asset over next 12 months, we can achieve optimal utilization levels, or it may take slightly longer time?
Now, once we, within 12 months, 6 to 8 months, we can see optimum levels.
And
the order book we have, we are very confident to achieve that.
And is there any addition of customer for this this facility? We already have 1 or 2 customers, but is it because you were in active discussion with more customers?
We already have a complete order book, and our production capacity is almost sold.
Almost sold. Okay. Thank you, and all the best.
Thank you. The next question is from the line of Deepak Jain from Enam Asset Management. Please go ahead.
Sir, can you talk to working capital, how it is poised for the next year, given that you are expecting a strong growth? On an absolute terms, will it remain there or it will expand? What is your view on that?
Working capital, Deepak, is right now at around 108 days, and our endeavor is to bring down by another 8 to 10 days. So we target the working capital days, net working capital days, to remain at 100 days going forward.
So can you share your outlook on Class 8 demand from the industry level?
No, I don't think I would be able to comment on Class 8, but overall we see the commercial vehicle market overall in North America is doing extremely well in terms of production. I don't see as a order book. As a production, all OEMs are sold out, and offtake of material is extremely good.
Okay. Okay, sir. Thank you.
Thank you. The next question is from the line of Ankur Kumar from Alpha Capital. Please go ahead.
Hello, sir. Congrats for a good set of numbers. So a couple of questions. First question is on the growth side. You are saying that next 2 years will be very good, but can you quantify? In this year we did 20% volume growth. Can the coming years be similar, or can they be better than this also?
First of all, I have never said for 2 years. I am saying for FY24 we are expecting strong growth, and we stick to that statement that we would not like to put a number to it. In terms of previous quarter, we have given a tonnage guidance of 15 to 20% growth. We would like to stick to that. I think we are expecting continued volume growth and revenue growth in this year, and we feel that the performance we have been able to achieve, we will continue with a strong performance in FY24 also.
Sure, sir. Next question is on the margin. Gross margin has come down this year compared to the last. So any reasons and what is our expectation on that front?
No, gross margin from last year it has improved. If you look at EBITDA per ton, it has improved by 2,500 rupees per ton.
Sir, I was asking in terms of gross margin percentage.
Percentage, yes. Percentage-wise, yes, certainly there was a cost pressure this year. That's why the margin, EBITDA margin has gone down by 100 basis points from the last year. But from here on, it will sustain at this level or improve from this level.
Sure, sir. And for tax rate will be 23 or 25% next year?
Yeah. Next year we will be moving to 25% tax rate, the 22% plus surcharge.
Sure, sir. Thank you.
Thank you. The next question is from the line of Pritesh Chedda from Lucky Investment Managers. Please go ahead.
Yeah, sir, I have 3 questions. The first question is in Europe and North America, what would be our CV dependence in terms of business? My second question is, if you could give the tonnage growth outlook for Europe, US and Asia separately if possible. And is there any deflation element in FY24 whereby there can be any price reduction or any for us to understand the top line?
I think first of all, in terms of Europe and North America or maybe India as an overall order book, 70% of my order book is from automotive sales, and this entire automotive sales is from different kind of commercial vehicles only.
Okay.
MNSCV or CV or LCV.
Okay.
We are not into PVs, and I have clarified that in earlier quarters also. We are in only commercial vehicle market across the globe in automotive segment.
Okay.
In North America or Europe, we also cater to the off-highway industry, oil and gas, and long-haul trailer bodies, as well as we have just entered the oil and gas in the Dubai and Abu Dhabi Gulf countries. So that is also a market which we are looking to grow considerably. In terms of deflation, all our contracts are tied up. In terms of inflation, we are not affected. In only
no. So my question here was, as on today, whatever you understand, will there be deflation in your realization next year driven by steel price?
I think steel price quarterly is a reset. In case there is a reduction in steel price, the top line may go down. In case there is a increase in steel price, top line will go up.
Okay.
But my margins and other things are not dependent on basically steel pricing.
Okay. Sir, your volume growth outlook for tonnage growth in Europe, US and Asia?
We don't have a bifurcated tonnage as of now. But surely we can ask our CFO to, you can have a one-on-one call with him to get all this.
And my last question is, sir, there is a working capital improvement for a certain extent driven by better payables. Can you explain the rise in the payables? What kind of credit and where are we getting?
See, rise in payable is basically due to the higher volumes also, and there is no such rise in the debtors commensurate to that. That's why it's that. If you look at my payable from last year, this year it is up by 35%, and my volume, my top line growth is also 31%. So there is no significant rise in payable that way. And if you look at my data has not rose that significantly, and that's why there is an improvement in overall working capital cycle.
Okay, sir. Thank you very much.
Thank you. The next question is from the line of Kaushik Mohan from Ashika Stock Broking. Please go ahead.
Hi, sir. Congratulations for the good set of numbers. Sir, I just wanted to understand some guidance, not on the exact number-wise. What would be your revenue mix on the railway and oil and gas, sir?
I think we are looking at almost doubling our sales to railways in this year. So I think whatever percentage right now, we are close to, I think, 3% right now. We are looking at 5% plus this year from railways. And in oil and gas also, we expect at least 100-150 basis points increase in share of business from oil and gas.
Sir, another question. Sir, how is the railway payments happening, sir? Is it like if you bill it today, like how long will they take it to put them cash in your banks?
From the date of dispatch from my plant, it takes the payment is received in my bank account within 25 to 26 working days.
25. Thanks, sir. I have another question. Can I ask, or should I come back on the line?
Please continue.
Yes, sir. Sir, I just wanted to understand another thing. You have a partnership with Titagarh for wheels. Sir, how much % of that entire project will be your revenue?
51%.
51%. And what will be the cost there, and how is the production going to happen? And what's the plan on that?
I think capex plan is close to 1,200 plus crores, and production is going to start. We expect the production to start from last quarter of FY26.
FY26 last quarter. Okay.
Yes.
So, sir, and how is your EBITDA margins over there, sir?
Right now, I think it's pretty nascent to speak on the EBITDA margins. We would work on it and come back basically in FY25 for that.
Sure. Thanks, sir. Thanks for this.
Thank you. Ladies and gentlemen, to ask a question, you may please press star 1. The next question is from the line of Vignesh Iyer from Sequent Investments. Please go ahead.
Congratulations, sir, on good set of numbers. I have 2 questions from my side. The first one is, I just want to know the tax rate. As of now, we're paying somewhere around 30% plus, 31, 32. That is probably one of the reasons being deferred tax coming in. I just want to know, are we going to continue in the same slab for the FY24, or we are going to switch to a 25% slab like many other companies in manufacturing are doing?
We are going to shift to 25% tax rate in the next financial year.
Okay, right. Thank you, sir. Yeah, and my second question is, just to understand from just purely a utilization point of view, our press is running almost like on 94%. Forging has been consistently doing above 100%. I just want to understand from where would the next leg of growth come? I mean, the higher
56,000 tons of production tonnage is going to get added in next 6 months' time. Within this quarter, I think close to around 20,000 plus tons is going to get added and start production, and balance is going to total 53,000 tons is going to get completed within first 6 months. And as well as the utilization level 94%, which is being shown, I think we will revise those percentages also in next 6 months' time. So overall, we see that things are going to be much better in this year.
Plus, there is a lot of capacity left in our fabrication plant ramp up, where we are doing the production for railways, where we have a lot of capacity left out for growing railway segment. So that is not added in tonnage.
Okay, that is separate. Okay, right. Yeah. That's all from my side. Thank you, sir.
Thank you. The next question is from the line of Naveen Matta from Mahindra Manulife. Please go ahead.
Yeah, thanks for the opportunity. Sir, I think the question I think we are all trying to grapple with is that we are, next year potentially some of the industry bodies in the US are saying that Class 8 might see a decline. So just one way of trying to understand this is, in case, assuming that the market is flat, how much can we outgrow based on our order book or market share gains that we are looking at?
First of all, I have not heard that any OEMs has come out and said that they are going to see market degrowth next year or this year. No OEMs have come out and said that. And second is that we are not into alone Class 8 in the North American market. We are across all platforms of commercial vehicles. Class 8 forms one of the part, and with our past experience in the current order book, we are extremely confident that the way we have improved our content per vehicle, we will be extremely doing well, and we are confident of outperforming the market. But we cannot put a percentage how much we will be able to outperform the market.
Understood, sir. And just based on, our product mix improvement, do we see scope for further margin improvement from current levels?
We expect to retain and improve both. You will see continued outperformance in terms of margins. I think we continue to work on improvements in terms of our structure of working, and I think this will result in continued improvement in bottom line of the company.
So it should be kind of more cost control led, OPEX cost control is what we are trying to indicate, that we can kind of improve margins from that side. Is that understanding right?
Yes.
Got it, sir. Got it. Thank you very much.
Thank you. We have the next question from the line of Mitul Shah from Reliance Securities. Please go ahead.
So thanks for follow-up opportunity. Sir, I have a question on this railway business in new JV. It will be forging and machining everything in-house, sir?
Everything has to be in-house.
Okay. And second question, sir, on the EV strategy. Can you give what is our current revenue contribution and for next 2 years, as already EV are now becoming sizable in the Indian markets, particularly in the two-wheelers and PVs. So we are anyway entering into these two-wheelers and PVs also?
Well, we are not entering two-wheeler, we are entering PV. And I think right now we are not in PV, so we are not affected with this EV strategy right now. But EV continues to be a big focus for us, and we have already updated in our presentation where we are in EV and what is the future for us, how we look at EV going forward for KSL.
Sir, on the same, this EV, this new investment, 51% for Suyo, 500 crore we are planning to invest over next 5 years. 100 crore we are planning to invest with a revenue potential of 500 crore. So would that be in a phased manner, or you expect in last 1 or 2 years it will reach to those?
No, I think we are expecting. Suyo has done close to around 12 plus crores already in the last financial year, and I think this year also we expect at least 3-fold jump in the top line from Suyo. And gradually we are putting in money, and our 100 crore investment is based on some assumptions and capex plans at Suyo to graduate from only motor supplier for a complete solution of e-axle and transmission in next 5 years from Suyo. But Suyo will form a formidable arm for RKFL as we continue our investment in Suyo till the tune of 51%. It will become one of the significant arms of RKFL in terms of our EV portfolio and EV visibility is concerned.
Sir, lastly on this, what would be break-even revenue for this Suyo?
Suyo is already break-even.
We are in profit, already in profit.
At 12 crore turnover also we are making profit.
Yes.
Okay, sir. Thanks.
Thank you. The next question is from the line of Rahul Shah from PK Capital. Please go ahead.
Yeah, hi. I just want to ask regarding this North American customer where you have an LTA. Can you just give me the broad contours of that deal in terms of, is there going to be a price revision with steel compensation or manufacturing costs increasing in India?
Yes, I think we have all our global contracts are backed by steel and inflationary changes. Steel is every quarter and inflationary changes every once a year. Steel and inflation and energy is every once a year.
Okay, thanks. And second question is on, you've installed some solar capacity at the plant. Is there any impact on this on the bottom line? Like what percentage of your energy costs are taken care of by solar now?
No, solar, we have just placed the order, and I think we expect the installation to get completed in 9 months' time. Once that happens, to that tune, our cost of electric energy is going to come down.
Okay, thank you.
Thank you. The next question is from the line of Chirag Shah from White Pine Investment Management. Please go ahead.
Yeah, sir. Thanks for the opportunity again. So just one clarification. So, you indicated that the Preston capacity is likely to get restated, right? Is it right? Because is it?
Yes.
Did I understand? So basically, your operating efficiency is improving over there, and hence the same effect is generating more.
Operating efficiency which is improving, we are improving in terms of automations which we are putting in will improve the efficiency. We are right now working and gauging exactly to what tune the capacity can be revised at, and accordingly in coming quarters the capacity will be revised.
So, sir, is it possible to indicate by when do you expect to come to a conclusion on this? Because this would be an additional lever on your operating leverage side.
I think you can safely say that at least in my press plant capacity is going to go up by 8 to 10%. But by August, this entire exercise is going to get completed. Second quarter should at least see 10 to 15% jump in capacity from the press plant.
Press plant. And so similarly on the ring rolling side, how much you can stretch it more?
No, I think we are working in ring rolling at the optimum.
So any thought of adding more capacity for ring rolling?
No.
Not required. Not. Okay. So this is helpful, sir. Thank you very much.
Thank you. Ladies and gentlemen, to ask a question, you may please press star and 1. The next question is from the line of Abhishek from Dolat Capital. Please go ahead.
Sir, you have mentioned that your interest cost has gone, your debt has gone down, but if you see the numbers like interest cost, that has gone up quarter-on-quarter basis and Y-on-Y basis. So, is it the impact of the increase in the yield, or is there last minute of change in the working capital, that's why it has gone down?
See, Abhishek, if you look at our all 4 quarter performance, so that has not gone down in the last minute, and it has gone on each quarter. If you look at all the 4 quarters number, okay, and the debt has only gone, interest cost has only gone up due to the increase in rate, and it includes bank charges also that increases due to the higher utilization of limits or non-fund based limits.
With the increase in top line, Abhishek, we have to use more LCs to get raw material. So LC usage, bank charges are also included in the interest rate, as well as while we are reducing our debt, we are not reducing our limits. Limits stay intact, and to get renewal of those limits, we need to pay commitment cost to the banks. So those charges are also built into that.
So how much increase in the interest cost in last 1 year because of the change in interest cost, increase in the interest cost?
It is almost 30%, Abhishek. It has gone up from 6% to around 8%.
Okay, got it, sir. And sir, as you mentioned that steel and energy contracts are renewed on yearly basis. So this year many contracts would be revised, I think.
We are still working with the OEMs. I think it will take another 1 or 2 months where we will have clear visibility. Okay. Because different countries have different mechanisms for energy and electricity and inflation. So we are working with the OEMs. I think we should be clear in next month or so.
But in other cases, it is based on the indexation, and it is renewed and on every 3 to 6 months. It is not with you.
Can you repeat your question, please?
Sir, in most of the cases, these prices are revised based on the indexations, and that is renewed on every 3 to 6 months.
That is for raw material basically, and for inflation and energy, it is dependent country specific. So we need to produce our own invoices, and the increases which has happened in India in gas, electricity and other denominators, and they are verified and then they are worked on. So it takes its own time.
Okay, sir. Thanks, sir. That's all from my side.
Thank you. Participants who wish to ask questions may please press star 1. The next question is from the line of Akshay Karwa from Anand Rathi. Please go ahead.
Hi, sir. Thank you for the opportunity. Just a question on CapEx. So what's the CapEx CapEx guided for FY24 and 25?
No, FY24, like we have said, whatever post dividend and debt, we are looking at debt reduction of 100 to 150 crores. Post debt reduction and dividend payout, whatever cash is there, we will deploy this cash back into the system to grow the capacities, both in terms of forging as well as in terms of value add.
Okay, sir. Okay, sir. No. That's all from my side.
Thank you. As there are no further questions, I would now like to hand the conference over to the management for closing comments. Over to you, sir.
Thank you all. I take this opportunity to thank everyone for joining. I hope we have been able to answer all your queries and questions. For further inquiry and information, you can get in touch with us or with our investor relationship advisors. Thank you and have a very pleasant weekend.
Thank you. On behalf of Emkay Global Financial Services, that concludes this conference. Thank you for joining us. You may now disconnect.